If you feel a little shaken about recent market volatility, or just want to make sure that you are well prepared for the next market downturn, stick around because I've got some key strategies to help you not only survive, but thrive during these challenging times. Now brace yourself and let's get into it. Some of you can remember, or at least have heard of, the dot-com bubble back in 2000 and the bear market that came after it burst. It felt like the financial world was falling apart. Stock plummeted and the S&P 500 dropped 23% just in 1 year, in 2002. For a lot of people, that was really a tough time. But with hindsight, it was clear that it was a necessary correction that we can frame as a check on the market excess of the 90s. The same reasoning can be applied to the 2007-2008 until a certain extent, even if the root causes were totally different. Anyhow, in a way or another, the result is pretty similar. People and companies going belly up. Now, let's rewind it a bit and let's go back to us. Either you are in the 20s, 30s or 40s, you may feel the exact same anxiety today. But here's the thing. While market volatility is tough, especially when you are newer to investing, still you have a lot more control than you think. Let's break down together 5 key steps to help you take control and come out stronger on the other side. Number 1, revisit your saving rate. During volatile times, tightening up your spending and focus on your savings can make a huge difference. Now, look back over the past year. How much have you saved or invested versus spent? Run a quick mental calculation and note those numbers down. If you're saving just a modest 10%, it might be time to set a more ambitious goal, for instance, especially if going forward you might need additional amount to cover for some exceptional expenses, such as college, mortgages, and so on. In this light, set a custom saving target based on your current and future situation and automate those contributions. A really simple strategy is to automate those contributions using the features of our e-banking. Alternatively, you can set money apart using your 401k, IRA, or other kind of accounts. Long story short, automating your investment can put your money at work, even when the market is down, and without you to be thinking too much about it. Win-win. Number 2, review your long-term asset allocation. Take a closer look to your portfolio mix of stocks, bonds, and cash. And here the big question, are you taking enough risk on your stock without endangering your long-term goals? There is no one-size answer to this question, but it all depends on your risk tolerance and your long-term objectives. Anyway, a tip that I can give you is always to check the fundamental ratio before you decide to invest in a company rather than another. Because once the financial soundness of a business is ensured, there is a reasonable ground to expect convergence between the earning generation potential and the performance of the stock itself. And the smart thing is that it's plenty of data providers out there, like Morningstar, Yahoo Finance, or Investing.com, just to mention some, that provide all those information that you need to value a company without too much effort. So let's take a look. Now, moving on, we can say also that younger investors can take on higher risk, simply because they have more time ahead to compensate potential losses. But if you're scared about market volatility, you can need a conservative approach even if you're young. Just keep in mind the trade-off between volatility and rewards, and according to this, balance your portfolio. Number 3, streamline your investment choices. A bear market can be a good opportunity to clean up your investment portfolio, consolidate accounts, and eliminate duplicate holdings, focusing on the other end on high-quality investments. If you are overwhelmed by individual stocks, consider streamlining and focus on fewer companies, and eventually consider also putting your money on funds or ETFs, just to diversify a bit. In any case, you have to be mindful of the tax implications, because remember that tax is the first and greatest expense in your life. Plus, they constantly reduce the efficiency of the compound interest effect, that is the main driver for wealth creation. Check the video on compounding here. Let's move on. Number 4, assess the adequacy of your safety net. During economic stress and financial downturns, it is absolutely critical to have a proper safety net. In this sense, it can be useful to review your insurance coverage so that you are covered for essential risk, but you also don't waste money on unnecessary coverages. Also, build up your emergency reserves. And to do so, my suggestion is to look always to cover 3 to 6 months living expenses, just to be on the safe side. Finally, step number 5, make reasonable investments in your human capital. Invest in yourself and use this time to get new skills. Update your knowledge and improve your financial literacy. Because you know that enhancing your marketability can pay off in the long run, especially during a strong job market. So you have to prepare yourself in advance to be ready once the opportunity comes. So here you have it, 5 reasonable steps to navigate bear markets and stay on track with your financial goals on the market, but also in your life. So remember, while you cannot control the market, and most importantly, as Peter Lynch used to say, you cannot predict the stock market, you can control your actions and decisions. Stay focused on what you can manage and keep your long-term goals in sight. So guys, we reached the end of the video. I really hope that you enjoy. Don't forget to press the subscribe button, the thumb up and the bell to remain always updated on the latest contents, always here, of course, on Beyond Alpha. Feel also free to share your view in the comments down below. Thanks for watching and see you in the next video. Cheers!
I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. So you can take advantage of the volatility in the market if you understand what you own. For those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know.